The business insolvencies in Canada has jumped to 87% in Q1 this year compared to last year. So this has been the biggest jump we have seen since Great Recession. And if you look into the details, we find out that over 2,000 applications has been received, and majority of them, over 1,700 of them, were straight out bankruptcies. And the remaining of them were actually the proposal to renegotiate the outstanding debt to the creditors. And if you look at the industries that are being affected, are basically majority of them were food and accommodation, then construction, then retail, then warehousing. So pretty much across the board. But the major one was food and accommodation. And there were three reasons were presented, the reason why these businesses are struggling. Number one, cost of everything has gone up. So cost of food, if you're running a food business like a restaurant, the cost of food has gone up. The cost of transportation has gone up because you have to bring the food to your restaurant to prepare for it. The cost of labor has gone up. Okay, so cost of running the entire operation has gone up. And thanks to carbon tax, your gas price, your gas and electricity bill has also gone up as well. And not to mention the taxes, which is going to government pocket as well. So everything from a tax perspective, from a cost perspective, has gone up. Okay. The second thing that has been presented was the foot traffic, the consumer foot traffic. The consumers are not coming out. They're not spending money to buy food and other services. So that means the discretionary spending, which was there before, it's not there anymore. So a lot of consumers, we're going to talk about that in later this video, that how the increased debt servicing cost eating the consumers discretionary spending, which is now we are seeing that not being spent in the restaurant business. Then, and number third was the debt. There's a lot of debt in the business side as well. So especially the CEBA debt, the Canadian Emergency debt that was offered to them, interest-free, 40,000, 60,000 to these businesses during pandemic, that debt was taken back earlier this year. Okay, so a lot of businesses were forced to return that debt back to the government, and if not, they were forced to pay interest on that. So that was a lot of pressure on those businesses to come up with extra payment to pay off that debt as well. So in addition to that, there is existing debt that they have taken from the banks to finance their businesses, and because the interest rate has gone up, the debt servicing cost has also gone up exponentially. So because of these three reasons, these small medium businesses are struggling, and a lot of them are filing bankruptcies as well. If you are an investor in the US, in Canada, or in Europe, and you are considering investing into Dubai real estate market, this video is for you, because we have a platform called Stake, which allows you to invest into the residential real estate market and start earning rental income right away without going through a lengthy documentation process or coming up with a heavy down payment. Stake is built upon the concept of crowdfunding. So it is democratizing the entire investment strategy and allows you to own a single unit of the entire investment portfolio. So you don't have to own the entire property, right? You can be part of the pool that can actually own a piece of property, a piece of real estate. So that allows you to start with as low as 2,000 dirhams, and you can slowly ramp up. So as you start investing into it, you can not only own a bit of real estate, but you also get a portion of the rental income on monthly basis. So it's a passive investment strategy, diversifying your portfolio from traditional North American or European markets into Dubai, which is hustling and bustling and growing very fast, and allows you to build your wealth over time. So don't delay. There is a link down there in the description. If you click on this, it will give you free 200 dirhams in your account right away to start with, and you can thank me later. Now you would think that the rate cuts is coming, so everything will be rosy and rainbows and sunshine and hunky-dory, right? Hang on, don't be too fast. Let's take a look at this news as well. So today, Bank of Canada announced that the households are coping well with the rising rates, right? We are not seeing any widespread financial stress in the system. We are seeing Canadian households are, dealing with the rising interest rate. They are adjusting their incomes, they're adjusting their expenses to be able to pay off the mortgage debt that they have as a result of the higher interest rate. So what you guys are talking about, I don't see any issues here. That's what the Bank of Canada is saying, guys. Okay, and further we go into this news article. They're telling us that Canadians are pretty fine. Majority of them are pretty fine with this interest rate level. they are not seeing a widespread financial stress in the system, which means they don't see the reason for cutting rates aggressively as of yet. Okay. Further down, they also talk about the credit card debt. So someone asked, okay, the credit card debt is also climbing. What are you going to say about that? And they're saying that it is also not widespread. Only 1 in 10 Canadians have their credit card payments close to 80% of their full limit. So, which is nothing. It's just fine. There's nothing to see here, guys. Just move along. And the third piece that also mentioned that is the business delinquencies that we talked about earlier in this video. So they're saying that, yes, we understand the businesses are struggling. Some of them are filing bankruptcies, but those businesses are right now catching up to reality. This is the key, guys. They're saying those businesses who are filing for bankruptcies, they're actually catching up for reality, which means the reality is higher rates for longer. So those of you who are wishing for rate cuts, that rate cuts will happen at some point in June and then everything will be rosy, sunshine, rainbows. Bank of Canada is saying it's not happening, guys. It's not happening as of yet. So they're not seeing anything, any particular reason why they should be cutting rates aggressively. Well, but they did not talk about one thing, and that is unemployment rate, which is ticking up. The last unemployment reading was 6.1%. It's going up. So when it goes up to 6.5, to 7, to 7.5, then things will start breaking up pretty badly. And I guess then they will start cutting rates aggressively. But by then, it will be too late to react to protect the economy. But hey, this is just me sharing my thoughts. You let me know what you think about that and how you see the economic situation is deteriorating in Canada and how you're going to protect your finances, financial freedom, for your kids' freedom as well. Let me know how are you going to do that in the comment section. And if you like this video, give me a thumbs up and subscribe. And I'll see you in my next video. Sorry for the interruption, guys. Just wanted to let you know that we have a team of realtors which is covering the entire GTA as well as some outside areas as well, like Brant region where I am based off, and I help out the clients in this region as well. So if you have any needs with regards to real estate transactions, buying, selling, investing, renting, let me know. There's a link down there where you can book a one-to-one consulting call with me, and we will be more than happy to help you out.